on your perspective. I own a lot of oil. But, you know, I think ultimately, I think we're going to move to $110 to $125 a barrel relatively soon, maybe in the next few months, maybe sooner if something does break out. But I think over the next few years, oil is going to take out the $150 a barrel high that we put in prior to the 2008 financial crisis, and we're closer to $200 a barrel. But it's not because of Syria. It's because of Ben Bernanke and whoever his successor may be, because of Abe in Japan, because of all the central banks around the world that are just printing too much money. It's quantitative easing, it's inflation that is causing oil prices to rise, not the other way around.
So bigger picture, I mean, you want to ask whether the higher prices of oil are coming from stronger demand or tighter supply. Right now, it's a combination of both, with the balance being tighter supply in these worries in the Middle East that were referred to by your previous guest. But I think the market, you know, can continue to move higher simply because people anchor on the 70s and think about these long gas lines and oil's a killer for the economy if prices get high. But they forget that we're a much less energy-intensive economy today than we were 40 years ago. And so we're more resilient when it comes to triple-digit oil prices than we were in the 70s.
Great point. Peter Schiff from Euro Pacific Capital joins us. Peter, you don't have to go back to the 70s. I went back to 2008 when we saw that huge spike in oil up to $140 a barrel in 3 months. It was down below $40 a barrel. That was entirely a monetary phenomenon. That is, it was the Fed first printing too much money and then getting too tight. Is that what's happening now?
Well, absolutely. First of all, that last point wasn't a great point. I would argue that we're more dependent than ever on oil. We have to import so much of it with dollars that we export. But there is only one reason that the price of oil is going up, that the price of gasoline is going up here in the United States. And that's because the Federal Reserve has to print a lot of money to monetize all these budget deficits and to keep interest rates artificially low. The result of that is that oil prices are rising. And it's a global phenomenon because, remember, we export our dollars all around the world, and so foreign central banks buy them by printing their own money. So this is all monetary driven. It's our fault. There is nobody else to blame. It's not the fault of Iran. It is a tax. We are paying higher gasoline prices because we have lower payroll taxes. This is how we are financing government. They're not taking our purchasing power through taxation. They're taking it through inflation. And it's not just oil prices. Americans are going to have to get used to a much higher cost of living. The price of everything is going to go up, and it's going to go sky high.
John Brady, Peter is right on certainly an important point, and that is, if you look at fundamentals, let's give people some hard facts about oil and gasoline right now. Our inventories for gasoline are at multi-year highs. People are using less of it. If supply is up, the price should have come down. What are the traders saying in the pits?
Well, I think one of the concerns that we may forget is that it's not so much the oil that we import from the Middle East, Liz. It's what our trading partners import from the Middle East, Germany and Japan. And if there's some type of shock to the global oil markets, it's global trade that's really going to suffer. I do agree with Peter's points as it regards monetary policy and the debasing of the dollar lending itself to this artificially high rate. And I think that probably will continue, as there were more murmurs in the pits this week about the Fed perhaps adding additional chapters to this whole idea of quantitative easing and Operation Twist. But keep in mind, too, it's our trading partners, Germany and Japan specifically, that really rely on that Middle Eastern oil.
Right, Pat, I still think Pat made an excellent point about oil because we are less energy dependent. Yes, he did. But we're moving on, Peter. We're moving on to David, ladies and gentlemen, we have a lot to cover here, and we want to give our investors out there the best opportunity to buy what's important. And Pat Dorsey, I'm going back to you as we do head, some people say, towards Dow 13,000. Whether or not that's an important number or not, the point is that equities are still very well valued compared to bonds, are they not?
Yeah, I mean, you think about the 10-year Treasury at 2%. In equity terms, that's 50 times earnings. Or you compare a 2% yield for bonds with a 7% earnings yield for equities right now across the board. And of course, that equity income stream grows over time. Bonds are fixed. That's why it's called fixed income. So you tell me which is cheaper, a 7% yield that grows over time or a 2% yield that doesn't budge?
Equities.
Peter, I mean, you're certainly buying equities, just not necessarily U.S.-centric, right?
Well, no. I mean, I'm buying the commodities. We own a lot of oil. We own a lot of oil stocks. We own a lot of gold and silver. In terms of gold and silver, gasoline is actually getting cheaper right now. It's not getting more expensive. So that shows you it's inflation. But we're buying stocks all around the world. I particularly like to buy stocks in a lot of the Asian economies, because that's where the consumers are going to be getting wealthier. They're the ones that are going to be buying all the stuff that Americans can no longer afford. So you want to own companies that are going to benefit from the growth abroad, not the ones that are going to suffer from the decline here at home.
John, how much do the guys in the pits really think about the numbers? I mean, I know you're not a big fan. Nobody's a big fan of Dow because they think it's a smaller index. S&P is a large one, much more important. But how much do these numbers play into trades?
Well, I think the 13,000 number at this level, David, has been rather large. And it's really large from a psychological perspective, and specifically for the retail investor. Recall in 2011, calendar year 2011, we sort of challenged the 13,000 level 3 times, only to fail at 12,900, 12,850. So getting above 13,000 is a sign of progress. It's a little bit of an emotional rescue, so to say, for an investor class that's been beaten up over the last 7-8 years. So psychologically, it's important. What the real race now is for traders in the pit is to see how quickly it takes to go from 13,000 to 14,000. And with monetary policy as easy as it is, and with the relative value in equities as compared to fixed income, it may be sooner than you think.
Well, it could be moot as well, gang, if Europe matters. And let's throw it out to you, the money guys. Does Europe matter? Pat?
Well, I think a lot of nastiness has been priced into Europe. I mean, we've seen some pretty mass downgrades of bonds. Markets have continued to move higher. And I think it's important to separate the economic impact of the current debt crisis in Europe, which is causing a recession in Europe. So Europe grows slower. Companies dependent on Europe will grow slower. And that's a real concern with the, I think, overblown risks of Lehman Mark II, which is, this fears of a global credit crunch, which are, in my mind, completely overblown. When you look at the relative levels of interbank lending rates in Europe versus globally, there is very little nervousness outside of Europe. And that indicates to me that that credit crunch, while it may pertain in Europe, is not going global, which is a critical difference between today and late 2008.
Well, Peter, I know you think the Fed prints too much money, but certainly the Europeans are printing a lot of money for their bailouts as well, are they not?
Well, they certainly are. But, one of the problems from Europe is that the situation might improve, at least in the short run. We might have more confidence in the Eurozone and the euro currency, and that's bad news for Americans because that will drive the dollar down even faster against other currencies. That means oil prices and other prices are going to rise, and it's going to put more upward pressure on interest rates, which is going to force the Fed to print even more money if it wants to keep rates from rising, and that just pours fuel on the inflationary fire. And who knows? I mean, we could be looking at back up. We were at $150 a barrel in 2008 in July and August. We can be up there again by this summer if we keep printing money.
Well, yeah, and
Hi, everybody. This is Peter Schiff from Euro Pacific Precious Metals, and I am holding in my hand the most innovative precious metals product that I've ever seen. This is called the Valcambi Combi Bar. This is barterable gold that in an emergency, we get a currency crisis because, Ben Bernanke is printing money like it's going out of style.
Stop moving so much.
Eventually the dollar crashes, right? And you want to use your gold. I have one over here. It's in my wallet, just like a credit card. This is one I've already...
What makes you say that the dollar is going to crash?
Before Barack Obama leaves office, there will be a currency crisis. The U.S. dollar will collapse, and prices in this country for consumer goods are going to go ballistic, and so will interest rates. And we're going to be living in an economy with unemployment closing in on 20% and double-digit inflation and double-digit interest rates. This is economic ruin that is coming, and it's because of the very policies that you're wanting Barack Obama to pursue. Well, I mean, it's just paper. You ever see one of these, Liz?
Yeah,
this is a $100 trillion Zimbabwe bill, right? At one time, this had a lot of value. It's now worthless. But if we have a currency crisis, people might not be willing to sell you anything for worthless paper. They might want real money. And the beauty of these bars is you can break them apart. You can break one of those, or you can break off. You just bend them. You can break off one of the corners.
So I would like to break one off, and I don't mean to ruin your bar here, but I'm going to now break it off live. Okay.
We'll bend it.
I'm scared.
Don't worry.
Oh, it's soft. Is this 24 karat?
It is. It's pure gold.
Okay, so I'm going to break off a whole.
0.9999
There we go.
There you go.
Okay. Golden bar is Peter Schiff. I'm not surprised it's you who's selling this thing, but.
The problem is few investors are actually listening. In fact, before you buy any gold, take some time to visit my website, goldscams.com. If you're an existing customer of ours, great, you already know the drill.
Be trickled down.
I did lose millions on paper in the decline. Probably be a good database to have. If you can get a database of young people that actually bought Obamacare, it'd probably be a pretty valuable database because you could probably sell these people anything. You know, if you're trying to sell some, piece of junk, and you're looking for somebody who might buy it, somebody who signed up for Obamacare, that could be a valuable list of suckers. That might be a way that the Obama administration can kind of offset the cost of Obamacare, is they can rent out that mailing list. Because that's, again, if you've got something that you want to sell that nobody will buy because it's a lousy deal, hey, they've got a database for you to email to, right? Because don't they get all this information about you? And when you sign up for Obamacare, they get all your details, so they can tailor make the marketing campaign, knowing that you've got a bunch of people who have already bought Obamacare, and so if they've done that, they're going to be vulnerable to any kind of any kind of sales pitch.
So that's why we've come up with our own alternative to junk silver bags. This is the Euro-Pacific Silver Barter Bag, and each bag comes with 250 ounces of 0.999 fine silver.
Then gold is down 5%. 2 years ago, you said it was going to go to 5,000. While we were on together talking about gold, you said gold had some demand because dentists like to use it in dental work. That was May 22nd, and since then, gold is down 5%. 2 years ago, you said it was going to go to 5,000. Well, it's at about 1,200 right now. My question is, Peter, people watch us because they want to figure out how to invest. They want a little advice. When are you ever wrong? When are you ever wrong, and how do you ever learn if you're never wrong?
Well, first of all, right, I've been consistently telling people to buy gold since it was under $300
and consistently
an ounce.
Wrong. And
so people who have been following
wrong.
my advice for the past 13 years and have bought gold are actually doing better than people who have just bought stocks. But I've also advised people to buy stocks. I haven't told people to only buy gold. I've told people to have gold as part of a portfolio. So you have to look at my
right
overall
now. You didn't
investment
say that the
strategy.
S&P
But
was
I
going
am
to
not giving
at
advice.
5,000. You said gold was going to be at 5,000.
I think it's going to be at 5,000.
You said it 2 years ago. You said it'd be there
Look,
now, and you're wrong. Are you ever wrong? And how do you learn as an investor if you never admit that you're wrong?
Look, I'm wrong a lot less often than almost everybody else that comes out on CNBC. I mean, all you do is parade people who are wrong. I mean, think of all the bulls who you brought out here on the stock market when the NASDAQ was at 5,000. Every time they come on, because the NASDAQ is still below 5,000. Do you tell them how wrong they were? Hey, you told people to buy stocks in 2000, and look, the NASDAQ is still lower. I'm the only one that can talk about it. And you guys put these time horizons on. I never came on the show and said, hey, I guarantee in 2 years gold's going to be 5,000. You always want to press me. When is it going to be there? When is it going to be there? I don't know for sure. No, but you're asking me when. I don't know exactly when it's going to happen.
Then why did you say 2 years?
How long was I coming on CNBC talking about the housing bubble and you guys were laughing at me when I was forecasting the financial crisis? Go to YouTube. Why don't you look at Peter Schiff in 2005 and 2006 and 2007? I'm the only person who was on CNBC and got it right. Nobody else but me. Just go look at the tape.
So you're never wrong. Peter, I think that this is actually
I didn't say that.
Dangerous.
You said
this
that.
Is
but
dangerous.
I will tell you this. I am wrong less often than every other guest that comes on this program. Bar none.
I'll have to ask my accountant about that.